In this video, we're going to talk about how you can grow a small account quickly with ETF options. ETF options, when combined with the right options strategy, can be one of the best and safest ways to profit consistently from the financial markets. Here, we're going to explore some of the reasons why. Firstly, what are ETFs? ETF is an acronym for Exchange Traded Funds. These are special companies that have been established to mimic the price action for a wide range of markets, including stock indexes, stock market sectors, various commodity sectors, and currencies. This provides great versatility for the active trader because even though one market may be quiet at any given point in time, another will be on the move. For example, the stock market may be consolidating, but a currency is trending, and so forth. If you wanted to trade the currency or commodity markets, you would probably have to resort to futures, CFDs, or spot forex pairs if you want the benefit of leverage. Trouble is, all these types of financial instruments carry unlimited risk, which means that should the market price action turn against you, you can potentially lose more than your entire trading capital. Your maximum risk when buying options, on the other hand, is limited to your investment amount. And if your preference is to trade simple long options positions, ETF options may be your best choice. Here's why. Firstly, most ETF options have low implied volatility, which is what you want if you're buying options. This low implied volatility also means that should the trade be going against you, your losses will be reduced because you have bought the options cheaper in the first place. Low implied volatility also allows you to give yourself the gift of time for the trade to work out in your favour. Secondly, ETFs are not prone to huge and sudden price surges that arise from news events such as earnings reports, management changes, new product launches or disappointments, SEC investigations, or the like. This is because they represent huge, underlying, often broad-based markets where the fortunes of individual companies can't affect the market as a whole. Thirdly, ETF options are traded on high daily volume, and since the underlying market is vast and broad-based, price action cannot be manipulated by market makers. This allows you to leave the trade active and sleep at night. Number 4. Unlike individual companies, exchange-traded funds tend to trend in a predictable and fairly even manner. Once a trend is established, it is more likely to continue rather than whipsaw all over the place. 5. ETF options can be purchased for a few cents, which is very good for traders with small accounts. For just a few $100s, you can set yourself up for over $1,000 in profit. It also means there is no need to employ advanced options strategies along with increased brokerage fees. You can just buy single options positions. 6. Since ETFs are available on securities other than stock market-based instruments, even though they behave like stocks, paying dividends and the like, you can use them when the stock market is showing price volatility. For example, the Dow Jones index might fall 300 points in one day, but on the same day, a commodities-based ETF may rise moderately, or a foreign currency-based ETF may even move sharply upward. This allows investors to broaden their portfolio of positions so that they are not entirely at the mercy of the stock market. ETFs are also ideal for those using the popular Trading Pro system, which teaches you how to approach option trading like running a business. Like any business, you need a portfolio of different products, in this case, option contracts, so that even if one product line only breaks even, your entire business still makes an overall profit. So let's look at a simple ETF options strategy. Let's say that you can see that the Japanese yen is falling. Did you know that the yen has an ETF on the US stock market? And there are also options on this ETF. Its symbol is the FXY. You use the weekly charts for the yen as your guide to how far the currency can be expected to move. You then apply Fibonacci percentages to anticipate your profit targets. So you purchase put option contracts on the FXY, each having a delta of -20 and at least 4 months to expiration date. Most brokers will give you the options delta. The cost for these options would be around 25 cents each. So, if you purchased 10 contracts, your risk would be 10 times 100 times 0.25 equals $250. This way, you risk the smallest amount, but with the greatest potential leverage, and 4 months for it to realise a good return on investment. ETFs will often move between 8 to 10% in value over a few months. This will push your cheap options deep into the money, where the profits can be spectacular. It is important when using the above strategy that you pay attention to position sizing. Never risk too much on any one trade. There are plenty of ETFs with options to provide multiple trading opportunities, and all you need are some trades with impressive profits to outweigh the small losses you might experience on other trades where your dirt cheap options with low implied volatility don't work out. Here are some of the more popular ETFs on stock exchanges in the USA. The QQQ follows the Nasdaq 100. GLD follows the price of gold. SLV follows the price of silver. The IWM follows the Russell 2000 stock index. TLT follows treasury bonds. EEM follows the emerging markets sector. DIA follows the Dow Jones Industrial Average, and the SPY follows the S&P 500 index. These are just a sample. There are many more to choose from, but some are more liquid than others. By choosing your own portfolio of exchange-traded funds and getting to know them as your friends, you can experience some impressive trading results.